Thank you to everybody at the National Society for High School Scholars for setting this presentation up and providing this special benefit to all of you as members. We're very pleased to partner with them to bring you this information. I'm going to go ahead and put that information back into the chat again in case you've just joined us. There's important information into the chat and we'll help you understand what it's for over the course of the presentation. Okay. Well, welcome to everyone for this important workshop, What Every Parent Needs to Know Now About Paying Less for College. My name is Cindy Menegaz. I'm the National Program Director here at SMARTTRACK College Funding. I came to the company as a client over a decade ago when our twins were in high school, and it was game-changing for us. So much so that I joined the company. So I'm really pleased to be one of your hosts tonight. And I'm very pleased that we are being joined by company co-founders Sam Mikhail and Scott Greenemeyer. SMARTTRACK co-founder Scott Greenemeyer has spent his entire career in finance, including 2 decades as an expert in college funding planning. Scott is also a certified college funding specialist master trainer and investment advisor and a former CPA. He's our trusted CFO. Scott's real expertise is that he understands the nexus between taxes and assets and college. Sam Mikhail leads our team as SMARTTRACK CEO. He is an Association of Certified College Funding Specialists Master Trainer as well, with over 25 years experience in audit, tax, and higher education planning, and he's a sought-after national expert. Sam, why don't you introduce yourself and let everybody know why you do what you do?
I grew up in Southern California most of my life, and we were considered middle income, and I had decent grades and thought maybe USC would be my dream school. While in high school, my father lost his job, and we couldn't really afford that school. And because of his job loss, I ended up going to schools where I can. My younger brother was now getting to high school, and I don't want what happened to me repeat itself. So we went and searched for help, and we ended up finding someone who did what we do. Now, back then in 1990s, there was hardly anybody that does what that do what we do today. So with a little bit of planning and direction and making some adjustments in our financials, my brother ended up going to a private school in Southern California. Didn't cost him a single penny for his education. So with college costs and living expenses going up, there's even more at stake for you today. We do what we do because of small adjustments that we make with you today can make a huge difference in someone's life, in their career, or how much less you'll have later in retirement.
Our nationwide team of licensed financial and certified college funding experts help families save more efficiently and pay less for college. We're one of the oldest, most reputable firms in the country and have been doing this for over 25 years, helping well over 400,000 families. Based on our experience, most of you will want to work with us, but not everyone needs all of our services. If you do end up needing advanced college funding planning and decide to engage us, our services are surprisingly affordable. We're talking a few $100s for comprehensive planning. We also stand behind our work with a 100% advisor guarantee. That being said, everyone will find this workshop really informative and beneficial. There is such a tremendous amount to teach you about college funding that we just can't cover it all in this one session. So we've drafted a workshop companion guide to go over everything in more detail, and you are going to want to check that out. We will email that to you. Also, save some time at the end. We will try to answer as many questions as we can. So there are 3 types of people that attend our workshops, we've found. There are the do-it-yourselfers, and we welcome you to learn the ins and outs of the college financial process. You're going to get valuable tips on how to improve your outcomes and save yourself time and money. I admit to being a bit of a DIYer myself sometimes. And then we have folks who think there's little or nothing that can be done to improve how much they will end up paying for college, and they just hope for the best. So I hope this workshop will change your mind. And then we have parents who feel a little confused and possibly overwhelmed by the whole process. And maybe you have a lot of burning questions, or maybe just aren't even sure where to begin and what to ask. All of this is common, totally normal. But we want all of you to get the most out of this workshop. No matter where you start, Success in the college funding process has two steps.
And step one is you need to get educated and informed about the college funding process and how it applies to you. I feel like I spent half my life trying to fix the mistakes caused by my clients, their financial people, their CPA, or they found on the internet, AI or whatever. And so college funding planning is not just financial aid system or filling out a bunch of forms. It's about how to make it easier and less expensive to pay for college. And that applies to everyone, regardless of your income, if it's high or low or assets are high or low. And so some of the things we talk about are on the screen. There's many, many more. As a matter of fact, we have 174 different strategies we might apply to your situation. We'll go into a lot of detail about that, how low income, high income, middle income families are assessed and how they can save money off the cost of college. And we'll explore various funding options and timing tonight. Now, the second step is to get a professional evaluation to find out which of the information you're learning here today applies to you and how it applies. So the society has made this evaluation available to you at no cost and no obligation. You can get a personalized, confidential college funding evaluation by a certified college funding expert with at least 10 years of experience in it. You'll get specific tips, recommendations based on your family situation. And so sit tight. We'll show you how to get access to that later. And after getting your evaluation, if you feel like this is something that you can tackle yourself, great. If you need some help, you can work with us or anybody else you like.
So take a look at these examples of current U.S. colleges' cost of attendance, or COA for short, for 1 year of college. It's a lot more than when I went to school for sure. Now, whether your child attends a public or private institution, in state or out of state, the full cost of attendance of a 4-year degree, that includes tuition, room, board, books, fees, transportation, etc. It'll run you between about $100,000 to as much as $400,000 or more. That's per child. That is a distressing reality for a lot of parents.
So as Cindy explained, colleges are very expensive today, but the good news is there are ways to reduce that cost. So let's talk about the different types of grants, scholarships, and aid. So the first is need-based aid, which is awarded based on parents and students' income, assets, and other factors. Now, there's a lot some parents can do to improve their eligibility in this area. So that's something you definitely want to speak to your college funding financial professional on, how to increase your eligibility for need-based aid. Then we've got merit aid. Now, this is available at most colleges, the biggest exception being the Ivy League and some Ivy League equivalent schools, which are called 100% need-based schools because they don't give merit aid and they'll always meet 100% of your need. However, most colleges still provide merit aid, and they use it as a tool to entice students that are towards the top of the academic profile for their college. And keep in mind, the top of the list varies dramatically from school to school, so you don't need to have a perfect student to find merit aid. And although merit aid is primarily based on the student's record, in some cases, it can also be impacted by how the parents' financials are organized. There's more about this in the workshop companion. Athletic scholarships are another source. Full ride scholarships are rare these days. Typically, they're going to be partial scholarships. The exception would be certain big money Division I sports. And then also remember, Division III cannot give any athletic scholarships. However, we've certainly seen, having a coach that really wants your student on their team can enhance both the admissions and other scholarship possibilities. And this is why the academics are, so important, even for student athletes. And then the last one is those private scholarships. Now, these don't come from the colleges. They come from, community organizations, Fortune 500 companies. They get a lot of publicity, but they make up less than 4% of the total scholarships that are awarded each year. They can be very time consuming to pursue and provide no guaranteed results. So there can be a lot of different financial aid application and forms depending on the college is being applied to and particulars of your family situation. You'll need to know, what each college requires, when to submit, how each assesses your income and assets. But here's a quick review of the two most common forms, the FAFSA and the CSS profile. So the FAFSA, this is a federal government form that is used by colleges' financial aid office to award aid from the federal government, the state government, if there is any applicable programs. Some states have them, some states don't, as well as any money that comes directly from that school's budget, or what's called institutional aid. Now, again, details regarding the FAFSA are included in the workshop companion guide, but one of the really important things that you need to understand right now is the timing of the information the FAFSA uses. So for income, they use what's called the prior year. So for a student graduating in 2028, they would be looking at your income from 2026. That's when this child's still in the 10th grade. However, and this is really important for families, that may have junior students, the assessment of your assets is based on what you have on the day you file the FAFSA, which is typically in the fall of the senior year of high school. So if you have a junior now, it's kind of 911 time. Don't wait till this fall when they're already a senior. It's important to get started right now. That senior year is going to be here before you know it. But again, due to how this timing works, some strategies involving income work best if actually implemented before that prior year. However, there are other strategies involving assets that work right up until the time you file the FAFSA. So the takeaway is start planning early if possible, but know that you haven't missed all opportunities if your student is already a junior.
Now, there's a lot of confusion on what is and isn't assessed on the FAFSA, and you're going to find tons of information that is contradictory. So I'm going to go ahead and just spell it out for you real quick. So under assets, these are the assessed assets, all your bank accounts, investment accounts that are non-retirement, 529s. Most trusted accounts are going to be assessed. Student accounts are going to be assessed at a much, much higher level. There's more information coming up later on that. Investment properties, child support, believe it or not, is not an income, but it's assessed as an asset for whatever reason. Under assets, what are exempted are your personal assets, like if you have a car, jewelry, that kind of stuff. Your primary home is not assessed, it's exempted. Any qualified or non-qualified retirement accounts, so that counts themselves, and small business valuation. As far as income, what's assessed are your W-2 incomes, some retirement contributions like a SEP and IRA, business, real estate net income, your interest, dividends, capital gains, retirement distributions, royalties, taxable Social Security, and any unemployment benefits you might have. What is exempted from that income are some qualified retirement contributions. So not the asset, but the actual money you put into it that year, 401k, 403b, and such. HSA contributions, spousal support, gifts, some workers' compensation, disability.
Okay. Then the second most common form is the CSS profile. And this is a much more in-depth financial application, which is required in addition to the FAFSA by a number of private colleges. Depending on the schools you're applying to and the particulars of your situation, there can be hundreds of questions. They're going to ask about your income, your assets, even your retirement accounts, businesses, rental properties, home equity, plus a lot more. Now, not all of the information they ask for is used directly in the financial aid formulas. And just as a tip, make sure you're being conservative with any valuations you provide on, things that are subjective, like your home value, your rental properties, your businesses. Be conservative on those valuations. Well, the colleges that use the CSS profile are using it strictly for the institutional aid, the money that comes directly from their school. All schools award federal and state monies off the FAFSA. Now, again, like we said, this form is very in-depth. It's complicated. Many are submitted with errors. However, they are very important. So you'll want to set aside ample time to complete it and make sure it's correct. Don't rush through it. There could be tens of thousands of dollars of institutional aid riding on this form every year.
Yes, like Scott said, this is even more intense than the FAFSA by far. So these are the assets that count on the CSS profile. Everything that the FAFSA assesses, plus parent 529s for all the kids. So if you have 3 kids with 529s each, they're going to group them together and count that as one asset. Plus, in your primary residence is a section devoted to what your house is worth, what you owe, and a bunch of other questions related to that. They're going to try to assess your small business valuation as well. And then as far as assessed income, everything that is assessed by the FAFSA plus any qualified retirement contributions, the money you put in from your W-2, non-taxable workers' comp and disability.
So, parents, your child should drive their college application process, but don't leave something as important as the financial piece to your 17-year-old. You really do have to manage this part. So, find out all of the required forms for each school and their specific deadlines. They may differ from admissions deadlines. And don't rely on what you see in a Google search. Just check each school to verify. I find that keeping a spreadsheet is really helpful. You're going to want to check your portals regularly to make sure that your file is complete. Just plan early, choose wisely, and submit correctly. But most importantly, make sure you discuss your situation with someone knowledgeable in these formulas and rules. You will be surprised what can be done for you. Now, Scott, will you talk to us about how colleges determine whether a family receives scholarships, grants, and financial aid?
Yeah, sure. So the starting point is what we just talked about, the FAFSA form and the CSS profile form. The information collected on the FAFSA form is used to calculate what's called a student aid index, or SAI. And then the information from the CSS profile is used to calculate an expected family contribution, or EFC. We'll just use the acronyms for the rest of the workshop for time's sake. So, that SAI and EFC reflects how much the colleges think you can afford to pay out of pocket per student each year. Now, many parents are absolutely shocked and dismayed by how high that SAI EFC comes out. However, keep in mind there are many things that can inflate those numbers. It's not just your income. It could be, like we talked about, assets, investments, businesses, passive incomes, which means there could also be many ways to lower that SAI or EFC with some proper planning. So the formula is the cost of attendance for the college minus that EFC or SAI equals your need, how much need-based aid you're qualifying for. So since that EFC and SAI is used to determine your financial need, they can make a huge difference in what you'll actually pay for college. So the lower your EFC, the greater your need. Some families will already have a low SAI EFC, and many families have the ability to lower that with some plan.
And like Scott said, the lower your SAI or EFC, the better, but also the more generous the college you're applying to, statistically, the better it is to get that need filled. So the best case scenario is to show as much legitimate need by lowering those calculations and then apply this at least some schools that are super generous to kind of fill in that need for you. And every college in America is going to want to make you think that they're the most generous college that ever existed. And this can't be further from the truth. Some colleges don't fill your need at all. Some fill it with a lot of expensive loans. And then there are generous ones that will fill your need with gifting that doesn't have to be paid back. So there's a premium software feature that we have. It's a tool that ranks all schools by historic generosity. And we refer to that as red, yellow, and green. So you're based on those calculations, you can see how generous that school has been statistically. And when researching colleges, don't just rely on their self-reported claims, endowment size, or their net price calculators. You really want to know statistically, how generous have they been for parents with your specific SAI EFC? This can make a huge difference in what you actually end up paying despite the sticker price. It can make a private school that might seem out of reach be less expensive in some cases than a public school. It's about making sure that you position yourself to get the best deal possible from every school your child applies to, and that includes applying to schools that have money to give you. So financial positioning and college selection fit together like a puzzle, and they work best together.
Okay, so now we're going to take a closer look at how different financial scenarios for families impact the strategies that are available to them. Again, keeping in mind every family situation is unique. Every family has different types and levels of income and assets, different school lists and academic levels of students. So therefore, there's no single strategy that works for every family. In general terms, families will tend to fall into one of the above four groups. We've got in that lower right corner, we've got, modest income, low assets, opposite that in the upper left or upper right corner, sorry, we've got, higher income and high assets. But then we've also got the combination of higher income with low assets, or the last scenario, low income or modest income with high assets. There's a bunch of different scenarios there. So we're going to take a look at an example from each one of these groups showing the specific challenges and opportunities associated with each. So let's start with that lower left corner, the modest income, low assets. This could be income, 75, 150, sometimes even up to 250,000, depending on the situation. But with very few assets. Now, this one is going to be the most straightforward scenario. Some of the advanced planning that we talk about is not as critical for these families since they're already going to be eligible for need-based aid. However, there are still some significant opportunities or things that they need to be aware of. So let's take a look at this scenario here. We've got Christine. She's a teacher, lives in Orange County, California. Had one child that's graduated in 2025. Income, 77,000. You can see, she has a little bit of non-retirement assets and college savings, but the bulk of her net worth is in her retirement accounts and her home equity. So let's take a look at the results that Christine ended up achieving. So the first thing I'll say is she did a couple things really, really well. Number one, she made sure she applied to some generous colleges. And number two, she completed all of her financial aid forms on time and accurately. So if you look at the sample awards on the screen, you can see that the two that were classified as red or yellow were pretty poor awards, but that wasn't surprising based on the fact that, they'd already been identified as red or yellow schools. But the awards from the two green colleges were actually very good. Now, Christine's daughter ended up attending that green college B for a cost that was lower than the public state schools that she applied for, saving over $250,000 a year. Over 40, sorry. However, and this is a big takeaway, is, we see families in the same situation getting these kind of results, and usually it comes down to one of two issues. One, not applying to generous schools, or two, making mistakes in the financial aid process, missing requirements, missing deadlines, reporting inaccurate information. And, in terms of the generous schools goals, that's something we just can't emphasize enough. The generosity level of the college is more important in determining the out-of-pocket costs for these families than the sticker price of the school. An $80,000 generous school can easily produce a lower net cost than a $50,000 school that's just not generous.
So let's say you're a family on the opposite end of the spectrum with high income and significant assets. Often they think that there's really nothing that can be done to help them. But most parents don't, they fail to realize that there's a lot of ways to save on college costs, even if they don't qualify for need-based aid. Let's take a look here. You might not be in exact situations here, but here's an example that still applies. So Paula and Nathan, their income is well over $600,000 with their bonuses, and their non-retirement assets are, more substantial. So there won't be any kind of need-based aid for them.
Okay, so I see we're getting some questions in the chat. We are going to take a few minutes at the end to answer, so please sit tight. Okay, but we're going to change gears here and talk about the ways that families can pay for college. Now, a lot of parents say they're going to pay for college from their cash flow, meaning their monthly income. Scott, can you talk a bit about that, please?
Yeah. So, given the high cost of college today, most families cannot pay for all of the college costs strictly from cash. However, paying as much as possible from cash flow is an important part of every college funding plan. Many families are actually shocked by how much hidden cash flow can be found in the process. Now, the other thing to keep in mind, though, is future cash flow is typically contingent upon your job and your health. Therefore, paying from cash flow is never 100% guaranteed.
Now, we hear from parents that they've been told by a college rep or read on a college website that there's like a hard and fast income cutoff for getting aid. Is that true?
Well, as we discussed, there are multiple ways to get free money from colleges. So if we're talking about academic or athletic merit aid, there's absolutely no cutoffs at all. For need-based aid, there certainly is a point where the family income will be too high to qualify. However, since there are other factors involved, assets, number of family members, age of the family members, how many in college at the same time, that cutoff point is not going to be the same for every family. And again, because of the high cost of college today, that cutoff point is often much higher than families think. And there also could be things that are artificially inflating their income that can be fixed, or they have income that fluctuates from year to year, or have an unusual one-time income that hits in a certain year. And there are strategies to help with all of these issues. Now, on the other side of the fence, we see families with, low income that just assume they're going to receive financial aid because of that low income. But Sam has a recent example of how that didn't end up working out for one particular family that he was working.
Yeah, we have a family in the Midwest that went on college visits. They have two strong kids. And so their income is between 125 and 145, depending on the year. They've done a great job of saving. They've had a 529. They've saved for the last 20 years for their non-retirement assets. And they made it a plan to talk to every college financial aid office to find out if they're going to be generous with them. And Yale was one of those schools. And Yale, this is directly from the Yale website. It says if your income is between 100 and 150, there's average scholarship is $63,000. And they told there's nothing to worry about. When they got their award, they only got $19,000. So what happened? Well, on the same site, just the next page down, it says here that Yale calculates the expected family contribution, that SAI-EFC, through a holistic review process. And part of that process is parent assets and student assets. So they failed to read the fine print and assume that the school was right based on what they're telling them. So it's really important not to assume that your income alone or your assets are too high or too low, whatever, that you're getting a financial aid. You really need to make sure that you plan to maximize that. So be diligent, read all the fine print, and most importantly, always plan ahead of time.
So as you've kind of figured out by now, that income plays a major part in the SAI or EFC calculation. And how it's actually calculated is similar to a tax calculation where the lower dollars of income are assessed at a lower percentage, but as your income goes up, the percentage assessment on that income also goes up, just like a tax rate schedule. So the top assessment is 47%. When you're thinking of income, most families just gravitate towards, their earned income, their wages or their business income. But, as Sam shared earlier, it also can include retirement contributions, interest, dividends, capital gains, rental income. So part of that college funding planning process is to manage the impact of these different income sources on your tax return. And frankly, most folks, even financial professionals, just don't understand how it all works.
So let's move on using assets to pay for college. So many families will consider using their checking, savings, CDs, money markets, investment accounts for stocks, bonds, real estate that they might own, as well as any other non-retirement assets. But without proper planning, liquidating assets may cause several different issues. These issues could be taxable event penalties. It could reduce your principal. That money is no longer working for you. Part of that TRP we talked about, that's very detrimental. It could hike up your EFC SAI. Happens all the time. We see it. So, for example, you might have an asset that doesn't count to begin with, but now you take it out of its shell And so now that asset will be assessed and you might have multiple issues and then lose out on money. So be very careful with that.
So, as Sam mentioned, not all assets are treated the same. Depending on the asset type and the methodology used by the college, you'll be assessed somewhere between 5% to 25% or even more on the asset's value each year. And student assets are assessed at a much higher rate than the parent assets. The student assets are the ones that are up around 25%. A lot of the parent assets are going to only be around 5%. So, we've seen clients that, disqualified themselves from $5,000 to $25,000 of free money each year just because they had 100,000 sitting in the wrong place. Based on our research, the average parents we see can reduce that FA or EOC or SAI by around $24,000 a year just by making some adjustments. And when we're talking about the impact of assets, keep in mind that a lot of assets have what we call a compounding income or compounding impact because they create income on your tax return. So this means you're going to be assessed on the value of the asset itself and the income it generates. This could be in the form of interest income, dividend income, capital gain, rental income. And this portion can be particularly damaging since, as we talked about, many families' top dollars of income are maybe being assessed at 47%. Okay, so moving on, and the third ways families pay for college is loans. And when it comes to loans, they can be a big part of many families' college funding plan. In some cases, it's required to fill a gap. They just don't have enough cash flow and assets to cover the bill. In others, it's a choice to finance some of the costs rather than depleting assets due to either tax consequences or opportunity costs associated with those assets, or could be to utilize a TRP strategy. Now, once again, there's a full explanation of the different loans in the workshop companion guide because we don't have time to cover all the details of the loans here. However, one important recent change is that there are new lower limits on many of the federal loans, and this is a very recent change. For undergrad students, the federal parent direct loan or PLUS now has new limits of $20,000 per year or $65,000 over 4 years for each student. For graduate students, the loan limits decrease pretty dramatically. So for some families, the idea of financing 100% of the cost through federal loans is just no longer an option. Here are a few other quick highlights to consider as you're thinking about the loans. Most families kind of lock into the traditional college loans, the federal loans, the private loans. However, there are many other ways to finance college. So you want to look at everything that's available to you. And when you're evaluating your loan options, consider all the factors. And one important factor that some people ignore is the repayment terms. Low interest rate is not helpful if you don't have the cash flow to keep up with the payments. This can be particularly true for families that have multiple students to put through college. And, since that interest paid on the loans becomes a big part of the overall college cost, having a plan to minimize the loans and having an effective borrowing strategy in place for the loans you do need can have a dramatic impact on the overall college cost. In fact, Sam's going to go through an example just to show you how expensive those loans can end up being.
Yeah, let's take a quick hypothetical. So you say you have an income of $250,000, you have a couple $100,000 in assets, maybe some 529s. Madeline's going to go to college in 2026. Luke's following in 2028. Their chosen college costs $90,000 a year. Without any planning, let's just be generous. They got, let's say, some money, right? $6,000 of scholarships, grants, and aid. That means their net cost is closer to $84,000. But maybe with some planning, that $6,000 might turn to $31,000 of free money. and their net cost goes from 84 down to 59, which is still a lot of money, by the way. Okay, but it's a lot less than 84,000. So that $25,000 spread, let's just assume that's the difference between can be able to afford it without loans or taking a loan. So if you took that $25,000 per year times 4 years for each child, that's 100,000, 2 kids, that's $200,000 that we save. Now, if we took that in a loan, that $200,000 is going to be at the lowest, fastest way we can do it with the current interest rates, with the current origination charges, and only a 10-year schedule. We're looking at that 200,000 alone being somewhere between 322 and $408,000 of repayments. And that's why it's so important to shave off as much money as you can. These schools have billions of dollars, in some cases, tens of billions of dollars in endowments. Some will spend it, some won't. And you want to make sure that you look as poor as possible and you maximize your aid potential there. Now, another thing that's huge that a lot of people, as we wrap up, don't keep in mind is that based on our research, we've discovered that 78% of our parents will go through at least one life-changing event during the college process. It could be a loss of a partner, a divorce, more kids. We've had that before. There could be job change, which happens a lot, or a loss of employment. It could be a sale of business, inheritance, retirement, or whatever. And so when you're dealing with that many years, there's a very high risk that something will go wrong and not as planned. So please, whatever you do, make sure you have a plan A, plan B, and plan C. Otherwise, you're susceptible to some issues, and then you're going to fall back on these very expensive loans and end up overpaying for college.
Come on. There we go. All right. So to wrap up our conversation about ways to pay for college, let's talk about private scholarships from employers, membership groups, corporations. They get a lot of attention, but they're typically smaller amounts. They don't often renew yearly. They can reduce your need-based aid packages too. So just be sure, parents, to manage your expectations. And if you are going to submit them, make sure you have your student apply early, ideally as soon as the window opens. And then it's not for everyone, but using a transfer option is a strategy for some families to reduce overall college costs. Here, the student attends community college to complete their general ed requirements and then transfers to the college of their choice as an upperclassman.
So all the scholarships, grants, and aid in the world doesn't mean a single thing for you unless your child gets accepted and makes it into college. And the competition out there is fierce. So we know some parents that we work with that will spend $500 a month, $1,000 a month or more on just admissions coaching. We don't think that you need to spend that much money. As a matter of fact, we have some very affordable admissions help that you can get if you need it. And it's offered by expert level packages at a small fraction of that. So that could be something, if you're interested, just let us know. Just write it down on your corner of your notes and we can give you more information. So the good news is step one, which is making sure that you're informed. You just did that. Okay. So congratulations. The next step is planning on how this information applies to you and what strategies that you need to apply and so you can get the best options. And so it could be anything. It could be qualifying for more grant scholarship aid to kind of reduce your total costs or improving your merit athletic-based awards. It can be using that TRP or some other kind of strategy and maximize asset recovery or reduce college costs that way. Capturing tax savings like Scott was talking about. Using very low-cost student loans or other loans that are maybe not a student loan, but could get a net, effective rate down to 3-4%, sometimes 2% in some cases. Growing and potentially protecting what you've already saved so that you have it later in retirement. Some, all, or maybe others that we didn't talk about. There's many options here that we can do to help you save.
Now, as we get toward the end of the session, I just want to go into some more detail about that second step of your college funding education, which is your personal college funding evaluation. Now, the Society has arranged for you to get this valuable benefit with tips and recommendations based on your specific circumstances and needs. The process is entirely private. SMARTTRACK never shares your information with any third party, not the Society or your school or the government or anyone else. And there's no cost to you, certainly no obligation. Um, we will give you honest, objective analyses of your positioning. Our advisors are all licensed professionals with extensive training and years of experience. It's not like you're going to reach a call center. Okay. So if your financials are relatively straightforward, we will point you in the right self-directed direction to get the resources you need that you can implement strategies on your own. And then if advanced planning can make a consequential difference for you, we'll let you know that too. You can choose to work with us or someone else or do it yourself, whatever makes sense for you.
So
Now, if
historically, we see
oh,
our, oops, sorry, go ahead.
that's okay. If you do decide to work with us, our comprehensive services are surprisingly affordable, probably less than you would spend on a couple of college textbooks. We developed our premium suite of self-directed software tools to help families identify schools on their list that could be generous based on historical generosity, right? That's the green, yellow, red ratings we were talking about. Helping maximize merit-based aid opportunities and support parents through the entirety of the financial aid application process. The discounted price for the premium software suite is $347 as a standalone for society member families. And then if we can significantly help you, we offer our one-on-one advisor service, which includes as many one-on-one meetings as are necessary to develop and implement your best college funding plan, covering all of the children in your family. Advisory service is $597, again, as a standalone on their own. And then we offer the SMARTTRACK Advisor and the premium software suite as a bundle for a one-time flat fee of $797 for our NSHSS families. That's not per student, it's not per year, it's a one-time flat fee. And note that this is in contrast to industry standard, which could cost you in the several thousands of dollars. So with the bundle, parents start their planning as early as 9th, 10th grade, and then use the premium tools once their student's college search has begun in earnest. And then it takes them all the way through senior year until they're matriculating into college.
And like Cindy said, the advisory covers all of our meetings. So it's a one-time thing. You're not paying every year or per child or anything. We want to give you maximum benefit. And historically, we save our clients 10, 20, $40,000 or more per year. And so we're so confident that we can help you save at least $10,000 over the college years that we're offering you a 100% money back guarantee on our advisory services. Really nothing to lose here.
Okay, so to get your SMARTTRACK evaluation and access the freemium tools on our platform, there are those two, you just have to create an account, but you've got to use the link for NSHSS member families. I put that in the chat. Use the email address you used to register for this workshop, ideally. And then don't worry if you can't access the chat right now, just look for our follow-up email that's going to come. So again, make sure you use the Society's custom SMARTTRACK link. Don't just go to our public-facing website or you will not receive the benefits available through Society. You should know our system can accommodate one parent account, no student accounts, and please don't try to create more than one parent account in the same household. If you already have set up your SMARTTRACK account, great. You can log in anytime at app.smarttrackcollegefunding.com. Again, it's all in the chat there for you. I'll put it in one more time too at the end in case you don't see it. And then creating your account is not enough, however, to get your evaluation. You have to complete a 5-minute assessment. That's the only way we're going to be able to give you feedback that's specific to your situation, right? So just let us know some basic information about you. It will only take maybe 5-10 minutes max. You should know also that we don't ask for any personally identifiable information, certainly no social security numbers or account numbers or tax returns, nothing like that. And the assessment is secured by military grade security protocols, so your information is safe and it's private.
And when answering those assessment questions, you don't have to have it right down to the penny. You don't need to pull all of your account statements and everything. You know, your best estimates will do fine. What's actually more important than being that precise is just making sure you're being comprehensive, you know, and all of the family members in your household, count all of your assets and all of your real estate for your income. You know, if you receive commissions stipends or bonuses on top of your salary include your entire salary, not or entire earnings, not just base salary. The more comprehensive the picture, the better we can assess and the more meaningful your evaluation.
Look, we do this every day. We love what we do. If you're going to have questions, the best way to get that is just to fill out the assessment, talk to us. Based on our experience, the vast majority of you are going to want meetings with us. Not everybody needs our meetings or needs the software. Let us help you kind of make a decision, answer those questions. That way you have better information to make those decisions.
Okay, so we're going to take some parent questions now, but before we do, just let me quickly recap your next steps so you know exactly what to do when we finish here. You are going to create your SMARTTRACK account using the Society link. You're going to complete the quick and secure assessment questions, and then just follow the on-screen prompts to get your college funding evaluation. Please look out for an email from us tomorrow. It will have a recording of tonight's presentation as well as the workshop companion guide.
All right.
Okay, go ahead.
Go ahead.
Oh,
Okay.
Sam, let me just say that, look, if we don't get to your question, we'll take as many as we can. Just we'll email you with an answer if we don't get to you, or honestly, the best way to get your concerns addressed really is going to be to schedule that complimentary evaluation.
Absolutely.
Go ahead,
So here's
Sam.
the
What do
first
you want to
question.
take?
Should I continue contributing to my 529s? We're not here to tell you you should or shouldn't, but most of the complaints that we get from our clients are like, hey, my 529s used to grow a lot better than they are now. So that's because of age-based, being age-based on their being more conservative as you start getting into middle school and high school. So there's lots of different options that maybe we can discuss that might give you more benefits than what the 529 does on its own. You want to take the next one, Cindy?
Oh, yeah, sorry, I was busy reading. Oh, about early action and early decision and what's the impact there. Yeah, so this is a really good question. So an early decision application is binding to the college, so you can only apply to one early decision school. And then if you're accepted, you have to pull your applications from the other schools. Now, the result is we sometimes do see that there are lesser financial awards because they're just not as incentivized to be competitive when they know that you're going in early decision. Early action, on the other hand, it's not binding and you can apply to multiple schools early action. And so it has a lesser impact on your financial aid awards.
So I see a question here regarding divorced or separated parents, how that works. So that one can get complicated and it depends on the college, which financial aid forms they use. It's definitely something you would want to talk with somebody about during that initial evaluation, because sometimes there can definitely be some money saving strategies around how that is structured. We obviously work with a lot of divorced parents. Sometimes they get along well enough that we can have meetings together. Sometimes we end up having to have separate meetings with each parent so that we can get the entire financial picture known for the family. So again, if you're divorced and separated and you get along, we can have meetings together. If not, we can have separate meetings. If you're married, we're assuming we can have meetings together. If you can't, well, then there's a workshop next week on how to deal with that situation.
All right, let me get the next one. I have a 2028 high school grad. Am I too early? No. So if you have a 2027 high school grad, 2028 high school grad, that's based on 2026 calendar tax year, which has already started. So every day gets assessed against you because you're already in your base year, like Scott was talking about. So you're considered 911. So 2028, 27s are just months away from filing. So you really, those are really urgent. Ideally, if you can, 2029s and 30s would be the perfect timing to get started with us. While we're at it, let me just jump to the next one. I have a strong income. Can you help me? Yes. About 30% of our clients make over $450,000 a year. Some even the seven figures. This morning I had one. Okay. There's multiple ways to save. And the people that think that there's nothing that can be done for them almost always are the ones we can help. So just keep that in mind.
All right. So I have one here. What happens if my situation changes after I file my financial aid forms? So there's a special process of that. It's called a special circumstance appeal, and it's available for families that, have a change in situation, which can happen a lot because you're filing, it's using income that's 2 years old by the time the student starts college. So a special circumstance appeal is available for families where their current situation is no longer adequately explained on the financial aid forms. Another one here, how do I know if the school is generous? So there are, since the schools are participating in federal programs, they're required to report data and statistics. Some of that's available on the internet if you know where to look. Some of it's confusing and hard to find. So in that premium software tool that we've talked about, we've done that work for you. We've classified those schools as green, yellow, or red based on their generosity level.
Hey, Scott, I just want to dovetail. I saw another question asking about our software. And do our advisors complete FAFSA in the profile on behalf of parents? No, our software is self-directed, DIY. So we have some 65 video tutorials, a 350 question and answer bank, and video tutorials throughout financial aid season. It's at live webinars throughout financial aid season. So we give you all of the tools so that you can feel confident that you can successfully complete those applications. By law, you have to do them yourself. So we've tried to answer and get everything you need so you can do it yourself. Thanks.
Can I jump in there real quick?
Yeah,
So
go ahead.
a complicated situation, you can still use the software to help you, save you a lot of time, errors, and stress. And then what could happen is all the complicated stuff, like your numbers or whatever, that's part of those assessment meetings where we can make those adjustments for you so that you can plan before you fill out the forms. So you don't need us to fill out your name, your address, your social security number. You can do that on yourself and save you a ton of money by using the software.
Hey, let me, Sam, were you going to take the next one, or is the next one up?
And let's wrap up because we
Yeah, we're about done. All right, so let me just answer this one question about applying for aid. Does it affect admission? That's such a good question. So there are some schools that are considered need blind, meaning they won't look at your financials when they are assessing your child for admission. There are schools that are need aware, meaning, yeah, they're going to look at your kid, but they're also going to look at your financials, and it could impact their offer to your child, whether they admit them or not. But you have to balance between wanting your child to get admitted to their choice school. If you can't necessarily pay for it, that's not necessarily a good thing. So it really just doesn't do you any good if your kid gets admitted to a school that you can't afford. So be aware of that when you're looking at need aware and need blind schools. You're right, you guys, we are over time. So if we didn't catch your, we didn't get to answer your question, we apologize, but get your evaluations. We'll try to email you with a response if we haven't already covered it. Okay. Guys, thank you so much. Thank you to the society. We hope you found this helpful, and we look forward to being of service to you.